I think most people think of volatility as bad. I think as a value manager, volatility is your friend, because what you're trying to do as a value manager is exploit other people's fear of volatility to be able to buy things at cheap prices. Even though stocks have rebounded since the beginning of the year, they're still substantially off their highs, and for reasons of economic uncertainty. And what's interesting about cyclical stocks is conventional wisdom is, I don't want to own a cyclical stock when we go into a recession. The reality is you do want to own a cyclical stock when they go into a recession. You don't want to own them before they go into the recession. But once the recession hits, the whole investment community starts thinking about the recovery. And so if you look at history, cyclical stocks generally do well during an economic downturn, unless that downturn is so severe that it threatens the financial structure of the marketplaces. And it seems highly unlikely that that's the case this time. When people get nervous about economic activity, they flock to quote unquote safe havens. So safe havens are government bonds. And so the yields on government securities went down because money poured in. Utilities, people feel safe with the steady dividend. Real estate, that's comforting to them. Consumer staples, things like food and beverages and healthcare, things that you have to consume whether there's an economic downturn or not. This is what attracts the money. So if you look at what happened during the end of 2018, the second half of 2018, money flowed out of the cyclical stocks, flowed into the safe stocks, creating a very wide valuation spread between the two. And the reality is they're not better businesses. They're stabler businesses, but over the full economic cycle, they earn just as much money. So if you can buy them for a lower price because everybody's afraid of them because the volatility crept up, then that's how you optimize and maximize your long-term returns. When people think about the prospect of a recession, they just dump their bank stocks. So banks, for example, if you measure from probably the last 9 months of 2018, these stocks fell by roughly 30% from peak to trough. Even though their earnings didn't turn down at all, there's no sign that bad debts are cropping up. Everybody's paying on time. It was fear. I fear there's going to be a recession. I fear that the recession is going to look like the last recession. So all I want to do is sell. And that's what creates a real opportunity, because now you're buying these franchises at a price point that's compelling. So capital is something like double the levels of where the banks were going into the last financial crisis. Liquidity is probably 10 times what it was. And by liquidity, I mean, what happens if the banks' access to the credit markets shut down? How long can they survive? And you could probably have measured that in months in 2007, 2008. Now it's in years. So the odds that you get such an extreme economic downturn where banks can't survive are about as low as they get, and yet they're nearly as cheap as they were in the financial crisis.